In this video, I'm going to teach you how options work. If you're someone who's interested in getting into options yourself, or you're interested in learning how to sell a cover call, this is the video for you. This is because in order to be able to sell cover calls successfully, you need to first understand how options work. So this video will be about giving you the basics of all of how options work for you to understand everything. As for myself, my credentials are that I have 3 degrees. My first degree came from a top 3 Canadian university. My MBA was done at a top 5 Chinese university, and I also have a third degree at an Ivy League institution. So I've essentially boiled down understanding options to these topics that you see here: contracts, premiums, in the money, out of the money, calls and puts, the strike price, the Greeks, especially beta and delta, and spreads. I believe that once you understand all of these terms, you will be able to understand options and potentially get out there and do options transactions of your own without feeling like you are lacking knowledge. So the first topic that we need to cover is understanding what a contract is. I'm pretty sure most of you understand how contracts work and what they are, but I'm just going to highlight a couple of key concepts that really introduce us into the conversation about options. Options are basically contracts, and contracts are basically agreements that two parties make that in the future they are going to complete some kind of obligation. So the easiest example we can think of is a real estate contract. In a real estate contract, there is a buyer and a seller. These are the two parties in this situation. And on a certain day, buyer is going to transfer the money, let's say $2 million, to buy the house. And on that same day, the seller will agree to also do something, an obligation, which is to sell that house, or sorry, transfer the deed of that house to the buyer who just gave up $2 million. Options are basically the same thing. They are contracts. And in this situation, the two parties are the buyer of the contract, the options contract, and the seller of the options contract. Buyer will agree to buy 100 shares of any stock uh, at a certain price on a certain day, and the seller of the options contract already owns 100 stocks of 100 shares of that stock, and they are willing to, on that same day, sell that stock at the agreed price in the option. Lastly, when someone sells an options contract and gives someone the opportunity to buy an option or basically buy a stock at a given price, they're not going to do it for free. So therefore, they are going to collect something that we call a premium. The premium is kind of like the price to own that contract. So another example would be the options market is kind of like a supermarket, and options contracts are the different items that you can buy in a supermarket. And the premium is basically the price of each option, right? So some items in the supermarket might be worth $5.99. That is known as a premium. Other items in the supermarket may be worth $29.99. That is also the premium of another item. So why would someone buy an options contract? Because like I just stated, to buy a stock at a given price, that sounds very arbitrary. Why would someone be interested in doing that? There must be some kind of value out there. And there is. And the best example to illustrate this is the one that going to give you right now. Imagine if someone approached you and they said that they needed money desperately and they were willing to sell you their house, which is actually worth $2 million on the market, for only 1.5. Would you do it? Would you take that option to buy it at 1.5? Well, yes, you would, because even if you didn't want to live in the house yourself, it's not the style of house that you want to live in. You can buy that house for 1.5, and then on the same day or even the next day, sell it on the market, and you know that you will be able to sell it for $2 million. So in that situation, the contract or the opportunity to buy that house at 1.5 um, and sell it on the market at 2 is valuable. And this is exactly why options could be valuable for someone as well. For example, if there was the opportunity to buy Nvidia at, let's say, $50, and on that day when the options contract expires and the holder of that options contract gets the option of either buying the Nvidia stocks at 50 or not, they would choose to do so if, let's say, Nvidia is at a higher price, $60, $80, $100, they would be willing to buy Nvidia at $50. Because even if they didn't want to hold Nvidia themselves, they can automatically sell it on the market for the market price. And because the market price is higher than the price they bought it in the option, um, they're going to make a profit. So that's why options contracts are valuable and in demand on the options market. People are willing to buy it. Now, not all option contracts are valuable. And this is where the term in the money and out of the money come from. So, in the money option contracts are valuable. They are like the example that I just gave earlier, the ability to buy NVIDIA at $50 when the market price is $100. And out of the money options contracts are basically not valuable. They're worth close to nothing, or they're worth a lot less than in the money contracts. And they might be slowly decaying and becoming less valuable. These are out of the money options contracts. And usually in the money options contracts, you can buy the stock at a lower price than the current stock itself. So in the money options would be like the opportunity to buy Nvidia at 50 when Nvidia's actual price on the market right now is 100. And out of the money options contract would be like the opportunity to buy Tesla at 400 when the current stock is trading on the market for 300. So the chance or opportunity to buy Tesla at 400 when the stock price is 300, wouldn't you say that is not valuable at all? That's what we call out of the money, because you could buy Tesla at 300 on the market and you wouldn't want to exercise your opportunity to buy Tesla at 400. Now, the next thing that you need to understand is a call and a put, which are terms that you may have heard of, but I'm going to show you how they work because this is probably the most important aspect of selecting options. If you can properly choose to buy a call option versus a put option, that's going to determine whether you're going to make money or lose money. So call options are if you think that the price of the option is going to move, or sorry, if you think that the price of the stock is going to move up, then you will buy the call option. So if you buy a call option and after you buy the call option, the price of the stock goes up, your call option is worth more and more and more money. If you buy a put option, um, and the price goes down, then your put option contract is going to be worth more and more money. Vice versa, if you buy a call option and the price of the stock goes down, your options contract is worth less and less and less. If you buy a put contract and the price of the stock starts to go up, your put option starts to go down. And I would say this is the most important thing to get right when you're trading options yourself. The next thing that you have to understand, which is going to come in tandem with um, calls and puts, is a strike price. Now, people who are new to options, they tend to overestimate the importance of strike price. Actually, the strike price is not as important as this calling, predicting whether it's a call or put uh, itself. Predicting whether it's call and put is much more important than predicting the strike price. But we need to know what a strike price is because it's going to help us determine how to buy a contract. The strike price is the price that you, if you're holding an options contract, are willing to buy the stock at on the day of expiry. So, for example, in the example that I gave earlier, I said there was the option to buy NVIDIA at $50 um, on a certain day, maybe the day when NVIDIA is trading at $100. $50 would be the strike price. $100 would be the price of the stock on the market right now. Okay. So essentially, the strike price is a set price at which the owner of the contract can buy the stock at and then sell it at. And again, it's not as important as calls and puts. All right. So if options were basically, to buy a stock at a certain price, why is it so risky? The reason why options contract are so risky is because of the Greeks. And the Greeks are what makes options very, very risky, more riskier than stocks. Mostly the risk comes from the first Greek, which is theta. Okay. Theta are risky because theta is basically a decay on the contract. Because in every example I've mentioned up to this point, there has never been the element of time, but there is an element of time in options trading that makes it very, very, very risky. Because not only do you have to predict the right direction of the stock, you also have to do it at a certain time. So let's go back to, let's give you some examples of this. So let's say um, if NVIDIA, the stock is currently trading at $114, would you buy the option to buy NVIDIA at 116? Well, wouldn't that also really depend on the time that you have for NVIDIA to get to $116, right? So if you only had a day for NVIDIA to go from 114 to 116, you probably would not want to buy it. Versus if I give you a year for NVIDIA to go from 114 to 116, you will probably buy it, right? That's because there is the element of time. See, if there was an option to buy NVIDIA at 116, and today NVIDIA is at 114, people are more willing to buy it if we had a year, if the expiry date was 1 year in the future. But people are less willing to buy it if you had maybe a week or a few days, maybe even a few hours. Okay, as the time is shorter to get to the price of 116, the contract of the option is decaying and decaying and decaying more. And the closer we get to the day where that contract expires and you have the option of buying it for 116, the more risky it is, and the less time you have for the stock to get to that price, and therefore that is what's causing the value of the contract to lose value, and that's the decay of the value of the options contract. So the second example I have here is, what if Tesla is currently at 280? Would you be willing to buy a call option, basically to buy Tesla at 385 in the future? Well, if the future is a week, maybe not, because a week does not sound like a lot of time for 280 to go all the way up to 385. Especially at the time of this video, we are currently going through the Trump tariffs, and we just saw markets drop like crazy this week, and it could drop even more because of the fear of a global recession. But what if you are really bullish on Tesla and you had a year? Then maybe you're willing to buy it because you have a year for 280 to turn into 385 or go above 385, making this call option more valuable. So therefore, maybe in a year, you were willing to buy it. That's because the theta has not decayed the contract that much yet. Versus if you only had a week, theta has already burned the majority of the value of the contract. And from a common sense point of view, to only have a week to wait for Tesla to go from 280 to 385, that's not enough time. So that's theta. In my opinion, this is the most important um, Greek. The second one is delta, and a delta basically controls the change of um, or how much it basically dictates how much the contract of the option is worth, aka the premium, based on the stock price. So basically, if a delta was like, let's say at 0.5, that means for every dollar that the stock price goes up, the options contract gains 50 cents. And that may not sound like a lot, that sounds like half, but remember, in an options contract, it's not one share of the stock, it's 100 shares of a stock. So that means each of the 100 shares in that contract is going up by 50 cents, which is why options, you can make a lot of money a lot faster or lose a lot of money faster um, than regular stocks. All right. Lastly, spreads. I'm not gonna talk about spreads just like this on the PowerPoint. I'm just gonna show you an example on um, Wealthsimple or an options chain. So you can see some of the things that we're talking about. So I'm gonna put up an options chain for us to look at, and hopefully that will help us see some of the things that we were just talking about. So here is the example of an options chain. Let's say we are interested in NVIDIA. So on Wealthsimple, if you buy NVIDIA, they give you two options. You can either buy the stock of NVIDIA or the option. So this page shows you the whole entire options chain. So at the top, you can choose between calls and puts. So remember, if you believe that NVIDIA is going to rise, okay, you will make money on a call if NVIDIA's stock price goes up within, let's say, 6 days. And then if you choose a put, uh, you will make money if NVIDIA's price goes down. So on Wealthsimple, you can very easily choose to buy a call or a put. The date over here is basically the date of expiry. So the day that you want to buy NVIDIA. So first option you have here is April 11th, but you can also choose April 17th. And it goes all the way down until all the way up to 2 years from now, which is uh, December 17th, 2027. The numbers that you see on the left here, the 97, 96, 95, these are the strike prices. And if you see right in the middle of the screen, it says over here, the ITM, that is in the money. So when we look at calls, for example, in the money options contract like this one here, these ones are valuable because NVIDIA is trading at $94. So the option to buy it at, let's say 93 or 90 or 85 or 80, that is valuable. Therefore, this is why you see that these numbers on the right, let's say like the 83 contract is worth $12.70. Their numbers are so much higher than, let's say, like go out of the money, they are worth 76 cents, 52 cents, 16 cents, all the way up down to 1 cent. It is because currently on this day, these contracts are at a strike price lower than the price of NVIDIA on the market, so they're valuable. Um, the opportunity to buy NVIDIA at $100 when NVIDIA is trading at $94, those are not valuable. All right, so let's click on one of these contracts to look at some of the additional things that we were talking about. So the Greeks that I was talking about earlier. So look at theta. Theta is negative 0.3107. That's telling you how fast this option is decaying. So a contract, let's say right now, that's going to expire in a week. The theta is negative 0.3335. But if I went to look at, let's say, a contract that's going to expire in 2 years, the theta is negative 0.0226, much less than the one we just looked at expiring in a week. Because again, theta is much weaker when we have a long time period, theta, the burn or like the decay of the options contract is a lot stronger when we get closer and closer to the day. So if we're 2 or 3 days out, the theta becomes a lot stronger. Lastly, the delta, remember, we were talking about delta. That's basically how much the options contract premium will go up based on every increase of NVIDIA market price. So if NVIDIA goes up by $1, each share of the NVIDIA shares in the contract will go up by 64 cents. So if you multiply that by 100, every time NVIDIA goes up by $1, this options contract is worth $64 more. So this is called leverage, and this is why options you can earn and lose money a lot faster. The last thing that I was going to show you was the spread. The spread is very important, and let me show you what a spread is. So the spread is basically the difference between the bid and the ask. Um, so if I were to look at, let's say, 96, the spread is, oh, quite large actually. Let's look at another one. Yeah, so the spread is from the bid, which is $4.75, to the ask, $4.95, about 20 cents. This is actually quite large, but usually when the market is open, the spread is usually like 1 cent between two. And you usually want spreads to be less because if you were buying a contract yourself, a low spreads means that when you're trying to sell the option, you'll get the price that you want. Versus if you were looking at an option that is has very bad spreads. Let's see if I can find one here. Let's look at TLT. Um, we don't see on TLT, but basically, whichever stock that has a large spread, let's say like $1 between the bid and an ask, basically, even if let's say the price went your way, you probably can't sell at the price that you were looking to get out because everyone who's wanting to buy the contract is wanting to buy it about $10 less. So yeah, that's everything that you need to know about options. Please, if you're interested in learning how to sell a cover call, I'm gonna plan to make a second video that takes the information that we learned from this video about options to properly sell cover calls and make a lot of income as we get through this time of hardship in the stock market due to Trump tariffs. So that's it for this video.